I think for people that are thinking of coming over here and people that are already here, the biggest consideration is most companies out here don't offer a structured pension scheme. The only jurisdiction typically was down in the DFC where they've got the Jews pension scheme, which came about a few years ago. The only type of scheme that they currently have outside of the DFC is something called a gratuity, which is effectively an end of service benefit. And different companies calculate that differently, but typically for every year that you've worked for that company, you would get 1 month of salary when you were to leave. So as an example, if someone's worked for a company for 10 years, they'll get 10 months of salary when they leave. However, the question is, what are you doing during those 10 years? That's 120 paychecks, which is a pretty significant amount of time. And if there isn't any structure or any kind of discipline during that time, again, there's going to be a big gap. There's no point saving into a pension scheme in the UK up until the age of 45, and then your last 10 years of retirement, 45 to 55, there's no structure, because then that might mean you might have to continue working for a few years. And the other big consideration is most salaries out here, obviously the tax-free, as Tom mentioned, they're typically a lot higher than they are in the UK and Europe, and that's one of the reasons why individuals come out here. So depending on their lifestyle, they should have an element of extra disposable income on a monthly basis. So being able to save regularly should be a lot easier here than in the UK. So the packages, the way that they are built, they're typically left to the individual's own devices. And again, it comes back to what is their personal experience, what is their education around investing, are they comfortable doing it themselves, are they disciplined enough in doing it themselves, or would they find value in working with someone like ourselves to have an element of accountability to ensure that journey and the amount that they are saving each month is a sustainable amount, but also is going to allow them to reach their end goal, not just for themselves, but for their families as well, because there is a lot of circumstances where there's only one individual in that family that will typically work, especially if they've got younger children. So again, that's a big consideration as well. So having the conversation is important initially, and then see if we can add value or map anything out for them.
I think something else as well that's worth talking about is how you can pay into your UK state pension voluntarily as an expatriate, something that 90% of the people that I speak to don't have no idea about. You leave the UK, you get excited, you come over here, you start working, and it's these little things that you can put in place once you're overseas that actually make a huge difference over the long term. I can't remember the exact figure, but you can pay something called Class 2 voluntary national insurance contributions, and it's something like just over £3 a week, and that will fill your missing years as you move forward, which is amazing. And it's probably one of the best investments you can make, actually, because it's not even the cost of a pint.
No,
right?
Definitely not out here.
Yeah.
It's about, like Tom said there, so it's about £180 for each year that you're missing contributions. And currently right now, which is also worth mentioning, there is a deadline, which is April this year, 2025, in order to backdate state pension contributions if you've got any missing gaps between 2006 and 2018. After April, you'll only be able to backdate the last 6 tax years. So again, it depends on how long somebody has been here. So that's a worthwhile consideration. And the way that the state pension works is you need 35 years of contributions to get a full state pension. That used to be 30, however, it changed recently. So 35 years of full state pension right now will give you around £11,600. Which is available from age 67. And if you look at that as a joint couple, it's the best part of £23,000, which is a reasonable amount. But then it's understanding what else have you got in place, and do you really want to be reliant on the UK government in retirement? For most people, they want to have an element of control, especially if they plan to retire before 67, because then you need to build in what is going to be the gap, say, between 62 and 67 to ensure that you can have that same quality of life again whilst you're fit, active, able. Depending on the individual, life can start to slow down, post 70, 75, 80. So that's also a big consideration, and that comes down to, you know, the lifestyle financial planning which we've built in recently within Hoxton, using the wealth flow and really understanding what people want out of life, you know, once they do stop working or if they transition to retirement. A lot of individuals out here, especially in you know, engineering, construction, oil and gas, those types of roles, might go into consultancy work. So they might go from 5 days a week to 4 days to 3 days to 2 days. So it's understanding, you know, what does an ideal retirement look like for that individual? How do they transition themselves from full-time employment into part-time employment into stop working completely, and building plans around that as well.
Fantastic. And I want to end on the fact that if I'm in the UK, I've got a pension and I'm now going to move to the GCC, okay, I can't really continue being looked after by my financial planner in the UK. How does it work here with Hoxton as an international company in the way that we're regulated in multiple jurisdictions? And why is that a benefit to the clients that then would use our service if they become international living?
I think, you know, as Ravi kind of alluded to earlier, the world seems to be getting smaller in the sense that people are more comfortable moving from one jurisdiction to another. When we first set up the business, you know, it was UAE and it was UK. Now we have offices all across the US, fully regulated by the SEC, you know, all across Europe, the Middle East, Asia, Australia. And, you know, basically what that means is if you're moving out of the UK, you could come to Hoxton Wealth and basically just say, look, this is where I am, this is where I think I might be. And basically it means we can look after you in a regulated jurisdiction wherever you end up. Which is something I think is really important to people, you know, making sure that they can have that continuity of advice, even if they decide to move on as they go through their career and through their retirement as well.
Fantastic. So we're looking at the UK, we're looking at USA, Australia. We work with clients all across the world.
Yeah.
And if a UK individual, say, for example, leaves the UK, goes to America, goes to Australia, comes into the GCC, they don't have to go searching around for a different financial advisor in every single country because we've got their back and we've got them covered.
Yeah, and we've got all the expertise. You know, we've got the tax advisory services, the mortgage services across all of these jurisdictions. So it means we can help them with everything. You know, their holistic plan as opposed to just their pensions. It can be, you know, the full package.